We have with us Asit Bhandarkar, who's the Senior Fund Manager, Equity at JM Financial Mutual Fund, joining us. Asit, good morning. So good to have you here. And, pleasure to be talking on a Tuesday morning like this. And what's your take on markets? And, of course, how the setup looks like, given that the narrative is completely changed from what it was a prior month ago. We finally have Iran and US on a 60-day MOU. Crude prices have significantly cooled off from their recent peaks. Do you think the setup looks more promising than what it was 2 months back?
Thank you and good morning. Happy monsoons. And yes, whatever you said now actually makes my job a lot easier. Yes, it does look better, and some of the reasons you already mentioned here. See, unfortunately, the setup, the way it has been over last 2 years is that markets have made very less money, right? I think single digit 2.5% returns on the Nifty, even in the broader market, it has not made much money over last 2 years. So investors' mood has been quite diffident about the markets. Too much volatility and too less returns was the trend. But I guess the volatility has come down very sharply through the last 3 to 4 months when we saw the disturbance in the Middle East. And my feeling is, with all things that are happening, the volatility should remain in control. We are also seeing that the rupee, which has been a big factor for FI redemptions, etc., out of the country, is also starting to look more stable given the steps that have been taken. And I think market now is sort of going to look forward and look at the key positives that can come through, right? I think a lot of fundamentally positive things have happened over the last 1.5 to 2 years, which probably got lost in all the volatility that was around. As market focuses on some of the positives there, quite clearly, I think, things might look a little better from here.
Okay, got it, got it. As if, in the month of May, we have seen that the SIP flows have definitely declined, and we've seen that more accounts have rather, stopped instead of more accounts getting opened. Do you think that this kind of, change in the geopolitical narrative gives the retail confidence to come back to equities as an asset class?
Well, of course, I mean, sentiments and human behavior obviously doesn't like, the kind of volatility and the kind of negative news flow that we've been sort of facing over the last few months, right? That said, I think, see, it also creates an opportunity for astute investors because market obviously has not focused on the fact that INR has depreciated so much. It can be great for exporters. Market is not focused on the fact that RBI has taken some steps by which the deposit situation of the banks can improve. Market is not focused significantly on the fact that we have signed some very solid FTAs with very large trading blocks, and that could be so good for business. So there are opportunities all along. Yes, I do understand that flows have not been so great, but I think look at it from a historical perspective. I think flows have been pretty solid, and in that sense, I would think the Indian retail investor has actually surprised us very positively through last 2 years.
Okay, got it, got it. Asad, where do you stand on the broader end of the markets? Because both mid and small caps, particularly small caps, they have they have stolen the spotlight when it comes to the June series. But what lies ahead, given the kind of recovery we have seen, from the March lows, and of course, do you think this kind of outperformance can sustain in the coming months?
That's a little forward-looking tough question, but I'll try to answer it in a better way. Okay, we run a small cap fund, and I was just checking yesterday that our 3 month returns are some 35%. So I mean, obviously, with this kind of returns, the obvious question is that, is this likely to continue or bulk of it is behind us? I think, see, that's where if you see the small cap index itself, the 2 year return of small cap index, if I'm not wrong, is about 2.7% total return, right? So not much has happened. Valuations have come off very sharply. A lot of entertainment market has given us up and down, but really speaking, not much money has been made. Stocks have compressed. We see so many opportunities in the broader market today, where for the growth that we are seeing and we can project, valuations are not so expensive. So I would think versus say calendar year 24, where we saw that the valuations were just too high and the ask for the growth rate was just too much, and there could have been headwinds in the horizon. Right now, what we are seeing is there could be tailwinds with the some of the crude price and some of the other commodities likely to cool off from here, and to that extent. There could be possibilities of earning surprises coming through if somebody has a view of say next 18 to 24 months, and I guess uh, I would think that the pace of return may not be the same as it was in the last 3 years, but the direction should be quite okay for this for the broader market as well.
Okay, got it, got it. So then what are you expecting in terms of earnings growth when it comes to June quarter and of course the overall FY27 for mid and small caps versus large caps?
Well, I think that's where the issue is really, right? I mean, there has been a disruption. It becomes very hazy to predict the first half of this calendar year. In fact, I would think that would weigh on the whole financial year of FY27, right? But I think, see, what we have to understand is markets have factored in perhaps what's the most likely negative things that could have happened, and we have to understand that markets are in a way, collectively they have collective intelligence of market sort of forces it to look a little ahead. While we may not know what could be the earnings for next quarter, or we probably expect that it will be weaker than what we initially expected, say 4 5 months back before the war started. But we also know that probably FY28, given the FY27 base, would be a much better year. So if we are having a horizon of 3 months, this is a tough market for us to predict. But if we are having a horizon of say 18 months, it becomes a lot easier, because the kind of headwinds that the world and the markets have seen over last say 12 months, right from the tariffs to the war and the currency depreciation, I would think they would all become tailwinds for the markets as we go ahead.
Okay, got it, got it. So any sectors, Asit, that could be worth visiting from the broader end of the markets
Oh,
or even overall as well?
sure. I would clearly think financials, which were sort of suffering from NIMS compression as the rates were going down, and now that we know that rates are not going down, I think clearly that sector looks well. And depending upon your risk horizon, there is a whole set of stocks to choose from. There could be some very high growth NBFCs. There could be some small finance banks which may have a significantly higher risk but much higher reward. But at the same time, the larger private banks also at these valuations look very attractive. Other than that, quite clearly, we are very excited in our portfolios for exporters. We clearly feel that rupee being at 94. Is a tailwind for some exporting businesses, and that has not been fully understood by the market, given the kind of trade disruptions we have seen over the last few months. And also, as we get into the second half of this year and maybe early part of next year, we'll start appreciating the role that the FTAs would play, particularly the European FTA and the UK FTA, which I believe is getting formalized sometime next month, as to what kind of impact it can have on businesses which can probably benefit because of the lower tariff regime incrementally. So these are the things that we're clearly focused on. We also like alternative energies. We also like engineered exports. We like probably even auto ancillaries to some extent. We are very excited about the EV transition. So these are I would think that there are a lot of ideas out there which need attention from our side.
Okay, got it, got it. What about the microfinance sector, Asit? Because we are seeing a bit of a stress easing in the month of May. There's a, delinquency levels have also eased up across all of these repayment buckets. Do you think this particular sector can be worth visiting given the kind of sell-off earlier also the sector has seen?
Uh, uh, you're absolutely right. I think the industry level data, as well as what we have seen across the companies that we track, we clearly have seen significant improvement in asset quality. We have seen the fact that as an industry, they have become very disciplined, asset quality has improved, and growth is sort of coming back. So it could be set up for very attractive. I mean, it's a very attractive position where growth comes back and with the disproportionate increase in profitability because of asset quality. That said, we have to understand that this is a segment which caters to the marginal section of the society. Small things can have very large impact. Like for example, if monsoons are poor, market will want to watch that. That said, if you ask me on reported numbers, does it look, a point where investors should notice them? Answer is yes, quite clearly. The prices as well as the fundamentals seem to be, fairly attractive. Yeah.
Okay, got it, got it. Asad, what's your view on IT sector? Of course, it's been the worst performing sector this year. Is it even advisable to for investors to play it as a contra bet?
I see. Our view has been that they are fundamentally very strong cash flow generating companies, and to that extent, they are not companies which can be ignored. That said, our stance in our portfolios has been that we'll be a little underweight with a bias towards higher growing names. So obviously, we would have some mid caps or small caps where there is some differentiated growth within the sector. There is no denying of the fact that business model has been challenged and it will have to go through its own ups and downs and maybe a resettling period. But they can't be ignored. So our point is, would we be happy? Would our returns be better over last 6 months if we were zero in IT? The answer is clearly yes. But we have chosen the path of not being zero weight here. We have chosen the path of being underweight here and focusing on higher growth names because there is an opportunity here in this kind of environment for companies to differentiate their business model, right? There is also an opportunity that AI brings in the long run. So the companies which can sort of turn around and shift their business model more meaningfully to help their clients with AI offerings, I guess they may end up doing better. There's also a huge opportunity for these guys to focus on their costs using AI. So I would think the verdict is not out yet on this sector. But that said, this sector has seen quite tough days, arguably so because of the AI disruption, which is meaningful and real.
Okay, got it. Got it. All right, just one last question before I let you go, Asad. So, what's the investment strategy that you would advise traders to have at the current juncture? We're just a few days away when the June quarter earning seasons will also start trickling in. All the companies will post their first quarter performance. So, ahead of that, what is the philosophy that they should adopt?
Well, that's a tough one. We are not great traders either, so I'm not sure if the person who should advise on trading is would be me. But that said, I would think that this has sort of become a buy on dips kind of a market. Uh, as we go forward into this year, we would see fundamentals settle and improve. Volatility is less. So this is a great market for investors with 18 to 24-month horizon to sort of allocate here as risks are coming off and fundamentals are improving. Shorter term, very difficult to say, but I would think most of the negatives, like say probably, which I can see, like one is sort of a weak earnings season, right? This would all be very stock specific or very individual sector specific. I would not expect it to have a very meaningful impact on index as a whole. That said, if monsoons, for example, don't work out well, which could be another risk, Then consumption in rural areas, etc., is something that we have to watch out for. These are two, three risks. But other than that, I think we are well set for next 18 months.
Okay, all right. Asit, on that note, we have to let you go. But thank you so much for your time and, of course, joining us.
My pleasure. Thank you very much.